Hi, everybody. Welcome to the Parallel Systems broadcast. I'm your host, Mike, and on tonight's show, we are going to be talking about gold hitting $4,000 per ounce for the very first time in history. And we're going to be looking at how the financial media are handling this massive run up in price in gold. What are they saying? Are they saying that this is the collapse of fiat, that this is the consequence of printing too much currency? Or are they saying something else? Of course, they're saying something else. They're never going to discuss that. So we're going to talk about that tonight. And if you stick around till the end, I've actually got some price predictions based on history as to where gold could go, not just this year, but next year and the following year. So let's get to it. Now, the first thing I wanted to say was if you was buying gold last week, let's say going into last weekend, you was planning to buy 10 shiny new 1 ounce gold coins, but for whatever reason, you delayed that purchase to today, the same 10 ounces of gold that you was about to buy last week would now cost you over $1,250 more in less than 7 days. That's the kind of run-up we've seen this year. The price of gold is now 50% for the year, and it's the eighth consecutive week of price gains if we finish this week up again. It's 7 already, 8 this week, and I think we are going to finish up positive for the week again. So that's kind of crazy. That says to me something very big is coming down the pipeline, and maybe it's going to be related to war. That's my guess, and we'll come back to that one in a future episode, I'm sure. Now, the last time we saw gold making price gains like this was the 1970s. So this is the best year for gold since 1979, which was the year before the epic, massive blow-off top in gold where it hit over $850 per ounce, which inflation adjusted using shadow stats is over $30,000 per ounce in today's money, which is why I am quite confident we're going to eclipse $30,000 per ounce in this current bull market. And that's going to be in real terms because we're going into a financial reset. Remember, the 1970s was only an interim reset, and I've got some very interesting articles from the 1970s to share with you later in the episode. So stick around for that. So let's go to the charts. Here we have it. The gold price is currently sitting at $3,981 per ounce. In the great shitty pound, we are now, look at this, nearly at 3,000 shitty pounds per ounce. That is quite astounding. I think the price of a sovereign now is over £800 or £900. That's insane. So this is kind of worrying in a sense to see the gold price going up so fast. Of course, if you've been protecting yourself in gold, it's because you expected worrying times ahead. Well, the worrying times are here. So I'm waiting for the narrative to come to justify these massive increases in price. I think whilst everything justifies this, if you look at this thing over here, the Ponzi pyramid, Exeter's pyramid, and I recreated this one, 2 to 4 quadrillion in derivatives and unfunded liabilities, hundreds of trillions in debt. Then we've got, of course, just tiny amounts of actual real stuff backstopping this. They've done everything they can to try and backstop the derivatives complex, including the great taking setup, which is where they've taken all of your assets and put it up there as collateral, all ready to be stolen in the end game. But there's only 2.5 billion ounces of gold and 4 billion ounces of silver out there, which is, of course, why we are seeing the massive run-up in price. That is the true reason. That is the narrative. But the financial media are not saying that. Look at this article from the Financial Times. Can you believe it? They said gold-plated FOMO. That's what this is. Gold-plated FOMO powers bullion's record-breaking rally. Now, just think of the language they're using there. FOMO, fear of missing out, gold-plated. That says something tacky, something cheap, something fake. And I think what they're trying to do is to steer people away from buying gold. Now, just think about the massive amounts of propaganda that exist out there right now trying to push you into assets like Bitcoin. You've even got the US government pushing it, BlackRock, all of the worst people in the world are telling you to buy Bitcoin. And you've got the financial media backing it up, saying it's a safe haven, it's a store of value, this is a sign of investor confidence. But when it comes to gold, it's FOMO. I smell a rat, a big rat. Let's look at what the article says. Gold's biggest rally since the 1970s is being stoked by gold-plated FOMO, fear of missing out, as investors fearful of missing out on returns and worried about inflation add the precious metal to their portfolios. The bullion price has rocketed more than 50% this year. That's crazy. That is huge. There's only about 4 years in history where gold has gone up over 50% in a single year. Well, actually, over 35% in a single year. There's only 4 years above that, and they're all from the 1970s, which tells us something important. But are people listening? I don't think they are. If you look at what the public are doing right now, they are net sellers of gold bullion. The buyers out there, well, it's the central banks and it's the wealthy families. They're all setting up for a financial reset. That is what is happening. The bullion price has rocketed more than 50% this year, hitting a record high of $3,940 a troy ounce on Monday, after US President Donald Trump's trade war sparked a rush to safe haven assets and sent the dollar tumbling. Well, actually, that's not quite true. We saw a rush out of traditional safe haven assets, which would be US Treasuries, and into gold. Now, that means the paradigm has completely changed. If you go back to every financial crisis over the last 25 years, the 2000.com crash, the GFC, 2020, what did we see? We saw a dollar spike. That's why we have the infamous dollar milkshake theory. It's the idea that everyone's always rushing into the dollar in a crisis. Not so fast. This time, I think we're going to see something very different because we aren't even in a crisis right now and people are rushing out of treasuries. They're also rushing out of all other foreign debt and they're rushing into gold. So that's why we created the reverse dollar milkshake theory. $28 trillion worth of marketable US treasuries trying to rush into only $400 billion worth of gold available annually at $3,500 per ounce. Now, this was made just a few months back earlier this year. Of course, the price is going up because what we're actually seeing is the reverse dollar milkshake take place. This is exactly what I predicted would happen, that we're going to see a rush out of dollars into gold. There's not enough gold out there, of course. It's a fixed supply. It comes out of the ground at a very steady rate. So the price has to go up to accommodate the new buyers. And that's what we're seeing. But as I've already said, retail is not buying yet. So we are a long, long way off from this becoming some kind of FOMO or blow off top, which the Financial Times would have you believe. Now, in terms of the trade war being a part of this, of course, it has been a part of it because people no longer trust the US. They think the guy running it is a crazy guy and he's just going to steal the stuff and put tariffs on them, take them off, tariffs on, tariffs off. It's a bit of a clown show. Also, of course, we're seeing this big push towards technocracy, the decoupling of East versus West. We're seeing World War III breaking out everywhere, cyber attacks, you name it, we've got it. That's the kind of period we're living through. Some people call it a fourth turning. Some people call it a winter of the cycle, or you could call it all of the above. So let's go back to the article. It says a key catalyst, say asset managers, has been a wider range of investors jumping on the bandwagon. Just think about the terminology they're using here, jumping on the bandwagon. This is all meant to diminish what's happening and to deter the reader from thinking, wait a minute, maybe I should have some of that. It's like, no, it's there to make it look ridiculous. Jumping on the bandwagon of soaring prices after years of record buying by central bank reserve managers. Now, that's important. They should be stopping and focusing on that for a second. Why are central banks buying it? Remember the episode I did a few weeks back about Dave Ramsey and he called it a commodity? And I said, well, wait a minute. Why aren't the central banks hoarding wheat? Why aren't the central banks hoarding oil or copper or lithium? If they like to hoard commodities, why only gold? Maybe there's something special about gold. Maybe it's actually got a monetary use. Of course, we know it does. And going into a financial reset, what do you need? You need real money, because when this thing comes down, all the other stuff disappears. The government bonds, they go to zero. The paper currency, it goes to infinity. not in value, but in price. Of course, the equities, bank deposits, well, bank bail-ins, they're going to take that off you. The derivatives and unfunded liabilities, well, that is a financial doomsday device set to take all of your equities. It's a mess. It's a big, dirty mess. So people are rushing down the pyramid now and into gold, but only really the people who know what's up. I would say this is the smart money or the connected that's doing this. Everyone else is reading the Financial Times and YOLOing on Pepe coin or Bitcoin or Trump coin or one of the many coins out there. Gold has become so big that you cannot ignore it. There becomes a level when it becomes impossible not to own it. But Luca Paolini, He said it's gold-plated FOMO, and he's the chief strategist at Pictet Asset Management, referring to a fear of missing out that is also seen as fueling gains in mega-cap technology stocks and other markets such as credit. So again, this is somebody who doesn't know his monetary history, probably schooled in traditional finance. So he says that gold is going up just like technology stocks and other markets such as credit. Well, not really. If you look at the NASDAQ this year versus gold, there's a huge difference in returns. Why is that? Gold is not typically correlated to the NASDAQ. In fact, it's inversely correlated to the NASDAQ. It is usually Bitcoin that is highly correlated to the NASDAQ. So I don't know why this guy is making these comparisons. My guess is that Luca Paolini actually missed out on gold, forgot to advise his clients to buy gold, and now is scrambling to create a narrative. That's just my take. The market has gone berserk, said Nikki Shields, an analyst at trading firm. Again, bit berserk. It's kind of trying to make it seem like this is crazy, it's not sustainable, and maybe it's not. However, as we get later into this episode, I'm going to show you it actually is sustainable and it's been sustained before. And if you understand what's driving the gold price, if you understand what's happening, then you know it's sustainable and you know it can't actually go any other way because it's based on debased currency, and also the toxic levels of debt in the system. There's no escaping that. You can only expand both because otherwise the whole Ponzi scheme collapses. And then you go to a financial reset, which revalues gold anyways. Okay, so an analyst at trading firm and precious metals refinery MKS PAMP, adding that the game-changing driver has been inflows into ETF funds, a cheap and popular investment vehicle used by both retail and institutional investors. So that's true. We are seeing a lot of people rush into the ETFs. It says here, net inflows into gold-backed ETFs surged to 13.6 billion over the past 4 weeks, according to World Gold Council data, meaning that more than 60 billion net has flowed in so far in 2025, a record for a calendar year. Now, of course, most people, when they learn about gold going up in price, if they are going to invest in it, they're going to go to ETFs. Pension funds may stupidly go to ETFs because they think that's an easy way to get exposure to the price, and it is. However, if you buy gold in an ETF, you don't own gold. What you actually own is exposure to the price. You own some shares that can be redeemed for dollars or actually taken from you if there is a collapse of the derivatives complex. So it's not the same at all. You've got all the counterparty risk and none of the safety. So it's a different asset in my opinion. But of course, most people don't understand that, so they rush into ETFs. Also, it says here, behind this recent price surge, the biggest since the 1979 oil price shock, is the first sign of a shift amongst investors. Now, this is very important, so listen to this. And it says the shift is from individuals to pension funds, and they're making long-term allocations to precious metals in the same way that they would do for equities and bonds. Now, like I said, if you go to the US, they are actually net sellers of gold coins. So the individual investors are taking profits. In Europe, however, it's very different. In Germany, you have a very high percentage ownership of gold coins and bullion. In fact, they have some of the highest private reserves of gold in the world. Similarly, Eastern Europe, very gold savvy because they've been through hyperinflations. The UK, not so much. However, this year we have seen record demand there as well. So some places are catching on, but for whatever reason, probably the propaganda and having Donald Trump, who is most influential to the conservative voter base, pushing cryptos, pushing shitcoins, pushing Trump sneakers and all the other stuff. They're busy buying that, and that's because that's what they're being told to buy. So the people who would traditionally be buying gold are actually selling it, and I would guess they're moving into crypto. Is that going to pay off, or is that a big trap? Well, I'm going to be writing an article on that later this week. But let's go back to this because this was very interesting. Morgan Stanley have now moved on from suggesting the traditional 60-40 asset allocation to a 60-20-20. Now, remember, the 60-40 was 60% equities, 40% bonds. Then in 2020, we saw bonds collapse alongside equities. So that portfolio is junk. So now they're saying 60% equities, 20% fixed income, and then 20% in gold. Now, I still think that is an absolute dog-turd portfolio. It sucks. It's awful. And I showed you in my recent Q&A, the wealth preservation pyramid. That's a much better portfolio. However, this is interesting because a 20% allocation to gold, if we're going to start to see that across pension funds, if we're going to start to see that across individual investors, and we're going to see that in investment firms, well, going back to this, you're going to see the gold price shoot up well over $10,000 per ounce. It's impossible. There is not that much gold out there. Most of the gold that is mined is already bought by central banks, meaning the supply available each year is minuscule. We're talking $1 to $2 trillion worth of treasuries trading each day. Imagine if just a few percent of that goes into gold. And then we've got 20% allocation with pension funds and individual investors. Yeah, the price will be over $10,000 before you know it. However, one thing I would say is that in the modern day, most people are driven by propaganda and narratives. So they don't have strong hands. If they buy something, they'll probably sell it if they see something flashy, new, and being pushed in the media. And that, my friends, is why I think we have cryptos. I think that's what they're there for. It's the off-ramp to stop people from going into gold. And that's why I think we see the financial media not pushing gold and instead pushing those assets. I think it's all by design. They want you in the wrong place at the wrong time in history. And it goes on to say, such a shift could mean trillions of dollars pouring into bullion and mark a major change from the 2% that fund managers currently allocate to gold, according to a recent Bank of America survey. For the first time in a long time, there has been a significant number of inquiries from clients exploring taking a long-term holding of gold, said Michael Widmer, head of metals research at the Bank of America. Some clients, said Valerie Noel, head of trading at Swiss private bank Sich Group, are keen on trades where they bet against the dollar whilst buying gold. Well, I would say that's a smart move. So there's some smart people out there, smart clients. Why would they be betting against the dollar? Well, maybe it's because Donald Trump and Scott Bessent have been demanding a weaker dollar. They're demanding that Americans are putting into even worse financial hardship. That's really what they're saying, because of course, if the dollar weakens, then what does that mean for your cost of living? It goes up, because I can guarantee wages ain't going up, and the value of the dollar going down, it's going to cripple hardworking Americans. So there's people out there who are listening to what they're being told, and they're saying, okay, well, let's bet against the dollar and buy some gold. People are looking to short the dollar, but they are not quite sure what currency to purchase. That uncertainty leads you straight to gold, because gold is money, currency is dog crap, and people, what they're going to do? Sell the dollar and buy the British pound? I don't think so. The Japanese yen? No. So that's, the price pushes you out of the currencies. And again, anyone with any sense can see what people are doing. They're going out of this. They're not going out of government bonds into paper currency. They might go into commodities at some point. We are seeing spikes in commodities. I think that's going to continue because the paper currencies will debase continuously. So we're going to see the price of commodities go up, and we're going to see commodity supply shocks as World War III unfolds. Land, yes, land prices have been going up fantastically over the past decade, but if you want liquidity, if you want ease of access, if you want to have no counterparties whatsoever, there's only one place, and that's right to the bottom of the pyramid, gold. Now, it should shock everyone watching this. It should be alarming that we are already seeing what I've been talking about since I started my show. Remember when I first showed you this pyramid and I discussed that people were going to be rushing into gold at one point and we'd be sat here watching it? Well, that's it. That's what we're seeing take place. That's why the gold price is up 50% this year. Now, I'm not going to go through the rest of this article. You can read it yourself if you want. There's nothing really that exciting there. But what I do want to show you is a few things, actually. The first thing is I've gone back through the archives, and what I wanted to look at was what they were saying about gold in 1974. Now, the reason for that is 1974 was the fair. No, sorry, 1972 was 1972 to 1974 was the years of the epic gold bull market in the 1970s. So we had a 50% increase in 72, a 73% increase in 73, and a 67% increase in 74. So I thought I'm going to go back and look at what they were saying in 1974 in the financial media, having seen gold double and then double again and then double again in price. And I wanted to know what they were saying back then to see if it aligns with what we're seeing today in terms of the propaganda. And guess what? It was just the same. So let me just go through this one. This was the bill that was allowing Americans from 1974 onwards to start buying gold coins again. And that's why I started in 1974, not 72, because Americans were not allowed to own gold in 72. It was illegal. Now, I'm sure they'd love to make it illegal today, but they can't. So let's see what they had to say. President Ford signed a bill today allowing American citizens to buy gold and sell gold after December the 31st for the first time in 40 years. Removal of the ban was part of the legislation that also authorized $1.5 billion for the International Development Association, an agency of the World Bank. Removal of the 40-year ban on gold ownership had originally been opposed by the Treasury, which believed it would encourage speculation in the gold markets. They're looking after you, kiddos. They're looking after you. They wouldn't want you speculating in the gold markets. You might get FOMO and affect the international monetary situation. Now, that's a little bit more honest, isn't it? But the Treasury relented in its opposition this year. The bill gave President Ford authority to end the ban before December the 31st. So there you have it. It was December the 31st, or just before then, when Americans were first allowed to start buying gold again. So let's move on a little bit. We've got this one here. Gold risk for investors. This was December the 27th. So already they were getting people very alarmed and concerned about buying gold, even though the price had been running up. And remember, it went up many times from here. And it said in less than a week, American citizens will be legally able to own gold bullion and speculate in it for the first time since the bottom of the Great Depression in 1933, when they stole the American citizens' gold by terrifying them into handing it over. That's what they did. It will be well for them to remember that gold buying is risky as any other form of commodity speculation. If the current world recession deepens, the recent inflationary boom in world commodity prices could turn around and gold could plummet as copper has already. So again, they was trying to make people think that gold was a commodity, which was actually quite a weird thing to do back in 1974 because it was still known as money. But this is when they was trying to shift over. There was the war on gold, propaganda around what gold is. And here's an interesting one. It says the First National City Bank of New York correctly points out that holding gold costs money, a form of negative interest. So gold is negative interest rates, my friends. Did you know that? While financial assets cost nothing to hold and yield a positive rate of interest, really? Always? Even if inflation's double digit and you've got a 2% bond? I don't think it does. Thus, if a savings account yields 7.5%, and gold costs 8% a year to hold, including insurance, storage, and brokerage commissions, the rate of inflation would have to exceed 16% for gold to be a better investment. So there you have it. They've just talked you out of owning gold. If the gold price should again be pegged, it could fall far behind other prices. From 1933 to 1968, gold was pegged at $35 per ounce. So again, trying to tell people to do the wrong thing at the wrong time. The worst possible advice they could give is what they was giving here. And then it also says that Citibank acted responsibly in deciding not to engage in selling gold to retail investors on the grounds that gold is likely to be an improper investment proposition for consumers. What was it, Dave Ramsey heading Citibank back then? I think it might have been. Let's go on to the next one. Gold re-enters marketplace today after 41 years. So this was on December the 31st, a very big day. Investors entered the nation's new golden era this morning with one hand on their wallets. For the first time in 41 years, private citizens were able to buy gold bars and ingots. And while there was anticipation in the air, there was also a healthy dose of skepticism. Now listen to this one. They have some experts in gold. So we've got dentist Philip J. Paul. He said, I'd sooner play blackjack with my money. And notice how they use professions that people, at least in 1974, had a lot of respect for. So Dr. Paul is no stranger to gold. He buys 40 to 60 ounces a year for dental reconstruction work. Nevertheless, he said he found gold much too volatile in price. This is what I heard recently about gold. It's very volatile. The thing is, it's volatile to the upside right now. So that's good volatility. The bad volatility is when you're seeing it crash down as well. That's not happened thus far. And over the past 25 years, it's outperformed the stock market. by over 3 times. So that's what you need to look at, that long-term trajectory, which is now steepening and speeding up because, well, I'll show you one more time because we're going into a financial endgame. We're going into the Greater Depression, as our friends over there on Doug Casey's take call it. So it says, bombarded with advertisements and the blandishments of brokers and retailers, many investors like Dr. Paul have been weighing the merits of gold against other types of investments. Interviews in a dozen cities and towns last week indicated that gold frequently came second best in comparisons. Somebody else said, this was a lawyer, so again, a very smart man. Gold is no panacea for the investor. Of course, if it goes to $2,000 an ounce, I'll have missed the boat. Well, you did miss the boat. It went to $850 per ounce by the end of the decade, inflation adjusted, over $30,000 per ounce. You could have bought 5 times the amount of property in 1980 with gold than you could have in 1970. And bearing in mind, they did manage to collapse the gold price. I was asked in a recent Q&A, do I think they'll be able to pull off the same trick this time? And I said no. So you can go back and check that one out if you're interested. I've been thinking about it, said Don J. Nelson, a professor of electrical engineering, but I decided not to buy. Then we also had this one. It was Sindlinger and Company of Swarthmore. I don't think that's a real place, by the way. Said more than 1/3 of the 1,120 people it surveyed in late December indicated that they would like to own gold. Almost 1 in 10 said they plan to buy it. However, spot checks in such cities as Boston, Chicago, and Denver, buttressed by interviews with financial experts like Dave Ramsey, disclosed widespread public skepticism about gold ownership, particularly in mid-America. And again, they said fluctuating prices. If you hold on to it too long, you might lose, kind of like the US dollar. So there you have it. That's what the financial propaganda was saying when gold had gone up 50%, 70%, 80%, back to back to back. And they were still saying the same old bullshit. So now let's fast forward to this. I wanted to share with you these price gains going into the 1970s. And of course, it continued later into the decade. And I recently wrote an article on my Substack called The Relentless Revaluation of Gold. And it's where I discussed how gold will be revalued twice. There will be a continuous, relentless revaluation going into the financial endgame. And then there will be a second revaluation once they do a Bretton Woods 2.0 because the old system has gone kaput. But what I actually did in this article was I overlaid the first 3 years of that major part of the bull market, 72, 73, and 74, onto the gold price. And I calculated where we'd be in the next few years. So let's do that exercise together, my friends. Now, I based it on gold being around $3,900 per ounce at the end of the year. Of course, we've already achieved that. So we're at 4,000. So the numbers would be even greater. But in 1973, like I said, the gold price rose another 73.5%. Now, if gold is at $3,900 per ounce at the year end and we add the next year's gains from the 70s bull market to that, we get to $6,770 per ounce by the end of 2026. And again, in 1974, the price jumped an additional 67%, and that would put us at around $11,300 per ounce by 2027. And of course, I've shown you many times that if we did follow the 1970s bull market and we started in 2020, which is when I think the financial reset began, by 2030, we would be over $30,000 per ounce. So is that going to happen? Well, I cannot tell you, but what I can tell you is what history says, and I can show you what's happening to the financial system. We've been right this far. I've got a feeling we will continue to be right going forward. So, my friends, please let me know in the comment section what you think of the financial media. You can leave a little emoji of a turd, or you can leave, what can we say for positive? You can leave a pint of beer if you think it's good. I love also for you to check out my Substack if you would like to take part in my Q&As, if you'd like to read my articles and access my financial newsletter. That would be awesome. And you can give the video a like and a thumbs up if you enjoyed it. In closing, my friends, take care of yourselves. Thank you so much for listening, and I will see you in the next one.